Hello everyone, I'm John Analyst. The artificial intelligence revolution is creating a silver demand surge that almost nobody in the investment community is factoring into their models right now. While everyone focuses on ChatGPT and generative AI applications, a quiet but massive build-out of data center infrastructure is consuming silver at rates that could fundamentally reshape the supply-demand balance within the next 18 to 36 months. Before we go further, subscribe right now because what you're about to hear explains a shift most investors still haven't noticed. The intersection of AI infrastructure expansion and silver's unique physical properties is creating a demand catalyst that has no historical precedent. Here on the Silver Reset, we dig into the data and the mechanisms that reveal where markets are actually headed, and what I'm about to show you changes the entire calculus for silver over the next decade. Let me start with the basics of what's actually happening in the AI infrastructure space. Every AI model, every data center expansion, every chip that powers machine learning requires massive amounts of electrical infrastructure and cooling systems. Silver is essential to both because of its unmatched electrical and thermal conductivity properties that cannot be easily substituted without significant performance degradation. The scale of the build-out is staggering and accelerating. Microsoft, Google, Amazon, Meta, and dozens of other technology giants are committing hundreds of billions of dollars to expand data center capacity specifically for AI workloads. These aren't marginal upgrades to existing facilities. These are greenfield constructions of enormous scale designed to handle the computational demands of training and running increasingly sophisticated AI models. Now, let me walk you through the numbers on what this means for silver consumption. A typical hyperscale data center uses silver in photovoltaic panels for power generation, in electrical contacts and switches, in busbar systems that distribute power, in thermal interface materials for cooling, and in the semiconductor chips themselves. The silver intensity per megawatt of data center capacity is significantly higher than traditional commercial buildings because of the extreme power density and cooling requirements. Industry estimates suggest that AI-specific data centers use approximately 30 to 50% more silver per unit of capacity compared to traditional data centers. This is because AI chips generate far more heat and require more robust power delivery and cooling infrastructure. The thermal management systems alone, which use silver-based compounds to transfer heat away from processors, represent a new and growing category of silver demand that barely existed 5 years ago. Look closely at this trend. Global data center power capacity is projected to grow from roughly 30 gigawatts currently to potentially 100 gigawatts or more by the end of this decade. The majority of that growth is being driven specifically by AI infrastructure requirements. If we apply conservative estimates of silver intensity per gigawatt, we're looking at incremental silver demand of tens of millions of ounces annually just from this single sector. But here's where it becomes important. This demand is not discretionary, and it's not price sensitive in the way that jewelry or some industrial applications might be. Technology companies are competing for computational supremacy in AI. They cannot afford to use inferior materials that might reduce performance or reliability. Silver's role in these systems is non-negotiable because the performance requirements are absolute. Microsoft recently announced plans to invest over $50 billion in AI infrastructure over the next fiscal year. Google has similar commitments. Amazon's AWS division is building massive AI-focused data centers across multiple continents. Each of these facilities represents millions of ounces of silver demand when you account for all the components, from the solar arrays powering them to the cooling systems, to the electrical distribution, to the chips themselves. Now notice what changed in the semiconductor industry specifically. The most advanced AI chips from NVIDIA, AMD, and others use silver in multiple layers of the chip architecture. As chips become more complex and more powerful, the amount of silver per chip increases. The transition to 3 nanometer and eventually 2 nanometer process nodes requires more sophisticated materials, engineering, and silver plays a critical role in achieving the conductivity and heat dissipation these chips demand. NVIDIA's H100 and upcoming B100 chips, which are specifically designed for AI training and inference, are being produced in quantities that would have seemed impossible just a few years ago. NVIDIA shipped over 3 million AI GPUs last year, and that number is projected to grow substantially. Each chip contains a small but measurable amount of silver. When you multiply small amounts by millions of units annually, you get significant aggregate demand. Let me explain the power infrastructure angle because this is where the demand multiplication really becomes apparent. AI data centers require substations, transformers, switchgear, and power distribution systems that are far more robust than typical commercial facilities. A single large AI data center might require multiple 100-megawatt substations, each containing thousands of electrical contacts, switches, and connectors that use silver for optimal conductivity and reliability. The electrical grid upgrades necessary to support AI infrastructure build-out represent another hidden source of silver demand. Utilities are having to upgrade transmission lines, install new substations, and deploy smart grid technologies to handle the load growth from data centers. Silver is integral to the contactors, relays, and switching equipment that make modern electrical grids reliable and efficient. Look at the projected power consumption figures from major technology companies. Some estimates suggest that AI-related power demand could account for 8 to 10% of total U.S. electricity consumption by the end of the decade. That represents an unprecedented concentration of electrical load growth in a single sector. Every megawatt of that capacity requires silver-intensive infrastructure to deliver and manage the power reliably. Now, let's talk about the cooling infrastructure, because this is an aspect most people completely overlook. Traditional air cooling is insufficient for the heat densities generated by AI chips running at full capacity. Data centers are increasingly deploying liquid cooling systems, which use coolant circulated directly to the processors. The thermal interface materials that transfer heat from the chip to the coolant often contain silver particles because of silver's superior thermal conductivity. Some of the most advanced cooling systems use silver-based nanofluids or thermal compounds that can handle heat fluxes that would overwhelm traditional materials. As AI chips become more powerful and generate more heat, the demand for these advanced cooling materials grows proportionally. This is a new category of silver demand that barely registered in industrial consumption statistics 5 years ago, but is growing exponentially now. But here's where the math becomes truly significant for the silver market. Let me walk you through a scenario analysis based on publicly available data and conservative assumptions. If AI infrastructure accounts for just 5% of total global silver demand today, roughly 50 million ounces, and that share grows to 15 or 20% over the next 5 years. As the build-out accelerates, you're looking at incremental demand of 100 to 150 million ounces annually. That incremental demand alone would exceed the entire current supply deficit in the silver market. Remember that silver demand already exceeds mine supply by roughly 150 to 200 million ounces per year, based on data from the Silver Institute. If AI adds another 100 million ounces of structural inelastic demand on top of existing deficits, the inventory buffers that have been absorbing the imbalance would be exhausted far more quickly than current models project. Now notice the timing of this demand surge. The AI infrastructure build-out is happening right now. Microsoft is breaking ground on new data centers. NVIDIA is ramping chip production. Google is expanding capacity. This isn't a 5-year out projection. This is current year demand that's already hitting the market. And it's accelerating because the competitive dynamics in AI are forcing every major technology company to invest at unprecedented scales. Let me explain why substitution is not a viable solution for technology companies facing higher silver prices. In theory, engineers could try to use copper, aluminum, or other conductive materials in place of silver, but copper has about 6% lower electrical conductivity than silver. In high-performance computing applications, where every fraction of a percent of efficiency matters, that difference is unacceptable. The resistive losses from using copper instead of silver in critical applications translate directly into heat generation, which then requires more cooling, which consumes more energy, which increases operating costs. When you're running a data center that consumes hundreds of megawatts continuously, the efficiency gains from using silver instead of copper pay for themselves many times over through reduced energy costs. The silver might cost more upfront, but the total cost of ownership favors silver decisively. Aluminum is even less conductive than copper and has other material properties that make it unsuitable for many of the applications where silver is currently used. For thermal interface materials, there simply is no substitute that matches silver's combination of thermal conductivity, electrical conductivity, and material stability under the extreme conditions inside an AI chip package. Look closely at what this means for price elasticity of demand. In consumer applications like jewelry, if silver prices double, demand falls because consumers buy less jewelry or switch to other metals. In AI infrastructure, if silver prices double, demand doesn't fall because the technology companies cannot compromise on performance, and the silver cost is a tiny fraction of the total project cost. A data center that costs $2 billion to build might contain $10 million worth of silver in various components. If silver prices double, that $10 million becomes $20 million. But it's still only 1% of the total project cost. No technology executive is going to compromise the performance or reliability of a $2 billion facility to save $10 million on materials. They'll pay the higher silver price without hesitation. This creates perfectly inelastic demand in economic terms. The quantity demanded does not respond to price changes. And when you have inelastic demand growth meeting constrained supply, the entire adjustment burden falls on price. Prices must rise high enough to either destroy demand elsewhere in the market or to incentivize enough new supply to rebalance the system. But here's the problem. We've already established that silver mine supply is largely inelastic because most production is a byproduct of base metal mining. New mine development takes years and faces regulatory hurdles. Recycling has practical limits. So the supply side cannot respond quickly even if prices spike dramatically. Now, let me walk you through what happens when you layer this AI-driven demand on top of the other structural demand growth we've discussed in previous videos. Solar panel production is consuming over 100 million ounces annually and growing as renewable energy deployment accelerates globally. Electric vehicle production is ramping up, adding tens of millions of ounces of new annual demand. 5G infrastructure rollout continues worldwide, requiring silver for base stations and network equipment. Each of these demand sources is driven by policy mandates, technological transitions, and long-term secular trends that won't reverse even in a recession. Solar deployment is backed by government subsidies and corporate sustainability commitments. EV adoption is being mandated by regulation in major markets like Europe and California. 5G is a national security and economic competitiveness priority for governments globally. And now you add AI infrastructure on top of all of that. This is a fourth major demand pillar, equally structural, equally inelastic, and potentially larger in scale than any of the others over the next decade. The silver market has never faced a situation where four separate megatrends were simultaneously driving demand growth at rates that significantly exceed the market's ability to supply metal. Look at the investment implications of this setup. If the thesis is correct and AI infrastructure creates a supply shock in silver over the next few years, we're not talking about a modest price adjustment. We're talking about a repricing event that could take silver well above its previous all-time highs near $50 per ounce, reached briefly in 2011. But here's where it becomes critical to understand the difference between that previous spike and what could happen this time. In 2011, the price surge was driven almost entirely by investment speculation and short-term momentum trading. There was no fundamental shortage of physical metal. When leveraged speculators got margin called and had to liquidate, the price collapsed from $49 back to the low 30s within weeks. The current setup is fundamentally different because the demand growth is coming from industrial users who need the metal for production, not from speculators chasing momentum. Industrial demand provides a much firmer floor under prices during corrections because industrial users don't stop buying when prices fall. They continue to need silver regardless of short-term price movements. If AI infrastructure drives silver to $50 or beyond, and that level is supported by genuine physical demand rather than speculation, the price would be far more sustainable. There would be corrections and volatility, certainly, but the structural bid from industrial users would prevent a complete collapse the way we saw after the 2011 spike. Now, let me explain what's happening with the competitive dynamics among technology companies and why this creates urgency in the build-out. The AI race is viewed by every major technology company as existential. The companies that achieve leadership in AI capabilities will dominate their markets. The companies that fall behind risk obsolescence. This is not an exaggeration. The stakes are that high. This means that capital constraints are essentially non-existent for AI infrastructure spending among the technology giants. Microsoft, Google, Amazon, Meta, these companies generate hundreds of billions of dollars in annual free cash flow. They can and will spend whatever is necessary to build the computational capacity required to compete in AI. Material costs, including silver, are rounding errors in their financial models. When you have deep-pocketed buyers who are price insensitive competing for a commodity with constrained supply, the outcome is predictable. Prices rise until some other participants are priced out of the market or until new supply materializes. But as we've discussed, new silver supply cannot materialize quickly. So the adjustment has to come through demand destruction elsewhere or through higher prices, rationing the available supply. Look closely at the timeline for when this supply stress becomes acute. Data center construction typically takes 18 to 36 months from groundbreaking to operation. The projects being announced now will be coming online and consuming materials over the next 2 to 3 years. We're not talking about a distant future scenario. We're talking about demand that's going to hit the physical market within the current investment horizon for anyone watching this video. Now notice what's happening with silver ETF positioning, because this tells us how the investment community is positioned relative to this demand surge. ETF holdings have been relatively stable over the past year, neither growing dramatically nor declining significantly. This suggests that investors have not yet priced in the AI infrastructure demand story. They're not positioning ahead of the supply shock. This creates an asymmetric opportunity for those who understand what's developing. If industrial demand from AI infrastructure starts to visibly tighten the physical market over the next year, and investors belatedly recognize the implications, we could see a surge of investment demand on top of the industrial demand. That would be the catalyst for a genuine supply crisis where available metal simply cannot satisfy all the competing demands at current prices. Let me walk you through the potential feedback loops that could develop once the market recognizes the supply stress. Rising prices attract investor attention. ETF inflows accelerate as investors seek exposure. Physical buying increases as investors lose confidence in paper markets and demand delivery. This removes metal from the available supply. Industrial users, fearing they won't be able to source metal at any price, start building inventories, which further strains supply. Mining companies and refiners cannot respond quickly enough to increase production. Premiums on physical metal explode as the spot market dislocates from the physical market. Dealers run out of inventory. Mints cannot produce coins fast enough. Delivery times extend from weeks to months. At some point in this spiral, prices gap dramatically higher as the market collectively realizes that there isn't enough metal to satisfy demand at anywhere near current prices. This is not a prediction with a specific timeline. This is a scenario analysis based on the logical progression of events if the AI infrastructure demand materializes as projected, and the supply side remains constrained as expected. Whether it plays out over 12 months or 36 months or longer is unknowable, but the direction and the ultimate outcome are highly probable given the fundamentals. But here's where investor psychology becomes critical to understand. Most investors will not position ahead of this scenario because it requires believing something that isn't yet obvious in the mainstream narrative. The AI infrastructure demand story is not on CNBC. It's not in the Wall Street Journal. Analysts are not writing research reports about silver supply shocks driven by data center build-out. By the time the story becomes mainstream and obvious, the easy gains will be gone. The investors who profit the most from major market dislocations are the ones who position before the consensus recognizes what's happening. That requires independent analysis, conviction in the face of skepticism, and the patience to hold positions that might not immediately validate. Now, let's talk about what the data shows regarding actual silver consumption in the technology sector currently. The Silver Institute breaks down industrial demand by category, and electronics represents one of the largest segments, consuming roughly 200 to 250 million ounces annually. Within electronics, the fastest growing subcategories are semiconductors, photovoltaics, and various specialized applications, including thermal management materials. The growth rates in these subcategories have been accelerating. Semiconductor silver consumption has been growing at mid to high single-digit percentage rates annually over the past several years. As AI chips become more prevalent and more sophisticated, that growth rate is likely to accelerate into double digits. Thermal management materials, which barely existed as a category a decade ago, are now one of the fastest growing segments of silver demand. Look at the capital expenditure announcements from semiconductor manufacturers. TSMC, the world's leading contract chip manufacturer, is investing over $100 billion in new fabrication facilities over the next several years, much of it specifically to meet demand for AI chips. Samsung and Intel have similar massive investment programs. Each new fab that comes online represents incremental silver demand for the manufacturing equipment and for the chips themselves. But here's where the math gets even more compelling. The chips produced in these new fabs have higher silver intensity than older generation chips because of the advanced materials and processes required. So you're getting demand growth from both increased chip production volumes and from higher silver content per chip. This double compounding of demand growth is unusual and powerful. Now notice what's happening with the power generation side of data center infrastructure. Many large data centers are being built with on-site solar generation to offset grid power consumption and to meet corporate sustainability goals. A large AI data center might have 50 to 100 megawatts of solar capacity installed on-site or through dedicated solar farms. That represents tens of millions of dollars worth of silver in photovoltaic panels for each facility. The combination of silver demand from the data center itself and from the solar generation supporting the data center creates a multiplier effect. AI infrastructure is simultaneously driving demand in electronics, in electrical components, in solar panels, and in cooling systems. It's hitting silver demand from multiple angles at once, and all of those demand streams are growing rapidly and simultaneously. Let me explain why the market isn't pricing this in yet, and why that creates opportunity. The silver market is relatively small and unsophisticated compared to major commodity markets like oil or copper. Many investors and analysts who cover silver focus primarily on traditional demand sources like jewelry, silverware, and coins. They understand solar demand because it's been growing for years and is well documented. They understand EV demand for similar reasons. But AI infrastructure demand is new, it's complex, and it requires understanding both the technology sector and the commodity markets. Very few analysts sit at that intersection. So the demand growth is happening in the physical market, but it's not yet reflected in investment positioning or in price. This disconnect cannot persist indefinitely. At some point, the physical tightness will become undeniable, and the investment community will reprice the market. Look closely at how this fits into the broader macro environment. We're in a period of historically high government debt levels, persistent inflation pressures, and central banks trapped between fighting inflation and supporting growth. Real interest rates, while positive currently, are likely to decline over the next year as central banks cut rates, while inflation remains sticky above target levels. Declining real rates are historically one of the strongest macro drivers of precious metals prices. When you can't earn a positive real return in cash or bonds, holding non-yielding assets like silver becomes more attractive. If we get the macro tailwind of declining real rates at the same time that AI infrastructure is creating physical supply stress, the setup for a major move in silver becomes extremely compelling. But here's what makes this particular moment in time unique. We've had periods before where silver fundamentals were supportive. We've had periods where the macro environment favored precious metals. But we've never had a situation where multiple technological megatrends were simultaneously creating structural industrial demand growth at rates that exceed the market's ability to supply metal, all occurring during a period of monetary instability and currency concerns. The confluence of factors is unprecedented, and that's why the potential repricing event could be larger in magnitude and more sustained in duration than previous silver bull markets. This isn't just a monetary play or just an industrial demand story, it's both, reinforcing each other, creating a situation where the market has to adjust dramatically to rebalance. Now let me walk you through what intelligent positioning looks like given this analysis. First, understand that timing is uncertain. The catalyst could arrive in 6 months or in 2 years. Trying to trade around short-term price movements is likely to result in being shaken out before the major move occurs. The better approach is to build a strategic position and hold through volatility. Second, recognize that physical metal has different risk and return characteristics than paper exposure through ETFs or mining stocks. Physical metal eliminates counterparty risk, but introduces storage and liquidity considerations. ETFs offer convenience and liquidity, but introduce counterparty risk and don't allow you to take physical delivery if supply becomes genuinely scarce. Mining stocks offer leverage to the silver price, but come with company-specific operational and financial risks. A diversified approach using all three forms of exposure probably makes sense for most investors. Physical metal as the core holding for long-term wealth preservation, ETFs for tactical trading and liquidity, mining stocks for leverage to a major price move. The specific allocation depends on individual risk tolerance and conviction level. Third, be prepared for volatility. Silver is one of the most volatile commodities. 50% drawdowns during bull markets are not uncommon. If you cannot psychologically handle seeing a position down 30 or 40% temporarily, you will panic must sell at exactly the wrong time. Position sizing matters. Only allocate capital you can afford to hold through drawdowns without being forced to liquidate. Look at the historical precedent for how silver behaves during major bull markets. In the 1970s, silver went from around $2 to $50, a 25-fold increase. But along the way, there were multiple corrections of 30, 40, even 50%. Investors who sold during those corrections missed the bulk of the gains. The investors who held through the volatility multiplied their wealth many times over. In the 2000 to 2011 period, silver went from $4 to $49, more than a 10-fold increase. Again, the path was not linear. There were brutal corrections in 2008 when silver fell from $21 to $9, a 57% decline, before ultimately going on to make new highs above $49. The investors who panic sold in 2008 missed the final and largest leg of the bull market. The pattern is consistent. Major moves in silver are characterized by extreme volatility, sharp corrections that test conviction, and ultimate price targets that exceed what seems reasonable at the beginning of the move. If you understand and accept this pattern, you can position appropriately and hold through the chaos. If you expect a smooth ride higher, you will be disappointed and will likely exit at the worst possible time. Now notice what's happening with mining company responses to higher silver prices. You would expect that at current prices in the mid-20s, mining companies would be incentivized to expand production. But the reality is that most primary silver miners are mature operations with limited expansion potential. New mine development is constrained by permitting timelines, capital availability, and the scarcity of economically viable deposits. The major silver producing companies have largely shifted to a capital discipline model, where they return cash to shareholders through dividends and buybacks, rather than investing aggressively in exploration and new mine development. This is a rational response to the commodity cycle volatility they experienced in the past. But it means the supply response to higher prices will be muted. For byproduct silver producers, the mining companies that produce silver as a secondary output from copper, zinc, or lead mines, their production decisions are driven entirely by the economics of the primary metal. Even if silver goes to $50 or $75, a copper miner is not going to accelerate production if copper prices don't justify it. The silver is a bonus, not the driver of their investment decisions. This supply inelasticity is critical to understanding why AI-driven demand growth could create such a dramatic price impact. Demand is growing rapidly and is price inelastic. Supply is flat to modestly growing and is also price inelastic. The only variable that can adjust to rebalance the market is price, and when both supply and demand are inelastic, the price adjustment required can be extreme. Let me explain what recycling can and cannot do to alleviate supply stress. Silver recycling from industrial scrap, old jewelry, and electronic waste contributes roughly 150 to 200 million ounces annually to supply. This is not an insignificant amount, but recycling rates are already quite high for the economically viable sources. We're not sitting on massive stockpiles of recyclable silver that would flood the market if prices rose. Electronic waste contains a silver, but the concentrations are low and the recovery processes are complex and costly. At current silver prices, much of the silver in electronic waste is not economically recoverable. Prices would have to rise substantially to incentivize more aggressive recycling efforts. And even then, the ramp-up time to build new recycling capacity would be measured in years, not months. Jewelry recycling responds to prices, but has limits. During the 2011 price spike, we saw significant recycling of old jewelry as consumers took advantage of high prices to sell unwanted items. But there's a finite stock of old jewelry that people are willing to part with. Once that gets recycled, it's gone. You can't recycle the same jewelry twice. Look closely at what this means for the inventory buffers we've discussed. If recycling cannot meaningfully increase in the near term and mine supply is constrained, then the deficit between demand and new supply has to be filled entirely from existing inventories. Those inventories are finite and declining. At some point, the holders of remaining inventories recognize scarcity and become unwilling to sell at prevailing prices. That's the breaking point. That's when the market dislocates and prices gap higher violently. We don't know exactly when that point will be reached because we don't have perfect visibility into all global inventories. But we know with certainty that if demand continues to exceed supply by 150 to 200 million ounces annually, and AI adds another 50 to 100 million ounces of demand on top of that, the buffers will be exhausted within a measurable time frame. Now, let me walk you through the geopolitical dimension of this story because it adds another layer of complexity and urgency. Silver is not evenly distributed globally. Major producing countries include Mexico, Peru, China, Chile, and Australia. The United States imports the majority of the silver it consumes. This creates potential supply chain vulnerabilities if geopolitical tensions disrupt trade. China is both a major producer and a major consumer of silver. If China were to restrict exports of silver to preserve supply for its own industrial needs, that would immediately tighten the global market. We've seen China implement export controls on other strategic materials like rare earth elements and gallium. Silver could potentially be added to that list if domestic demand from China's own technology sector continues to grow. The U.S. government has identified supply chain resilience for critical materials as a national security priority. Silver is used in defense applications, in munitions, in electronic warfare systems, in satellite technology. If geopolitical tensions escalate and access to imported silver becomes uncertain, the U.S. might need to rebuild domestic production or establish strategic stockpiles. Any move by governments to secure silver supplies for strategic purposes would remove material from the commercial market and tighten supply further. This is a low probability but high impact scenario that adds to the asymmetric risk-reward profile of silver. The downside is capped by strong industrial demand and constrained supply. The upside is potentially unlimited if multiple catalysts align. But here's where it becomes important not to oversell the thesis or make it sound like a conspiracy theory. Everything I've laid out is based on observable trends, publicly available data, and logical analysis of market mechanics. AI infrastructure is being built at massive scale. That's a fact. Data centers consume silver in multiple components. That's a fact. Silver supply is constrained. That's a fact. Demand exceeds supply. That's a fact. The conclusion that this creates a supply shock is not a guarantee. It's a high probability scenario based on the trajectory of current trends. Markets are complex and unpredictable. Unexpected technological breakthroughs could reduce silver intensity in certain applications. A severe global recession could temporarily reduce demand. Governments could release strategic stockpiles. Any number of variables could change the outcome. What I'm presenting is a framework for thinking about the silver market based on the best available information and the most logical interpretation of that information. It's not a prediction with a specific price target and timeline. It's an analytical thesis that suggests the risk-reward for silver is extremely favorable given the confluence of factors we've discussed. Here on the Silver Reset, we focus on data-driven analysis and logical reasoning rather than hype or sensationalism. The AI infrastructure story is compelling because it's grounded in observable reality, not in speculation about secret shortages or manipulated markets. Technology companies are spending hundreds of billions of dollars building data centers. That's happening. Those data centers require silver. That's a material science fact. Thanks for watching. Subscribe to the Silver Reset right now. Share this with anyone who's interested in understanding how technological change creates investment opportunities in commodity markets. Comment below with your thoughts on the AI infrastructure build-out and how you're positioning for potential supply stress in silver. Stay alert, because what's happening in the silver market right now matters more than most people realize. The AI revolution is creating demand that the market is not prepared to supply. And the investors who recognize this shift before it becomes obvious will be positioned to benefit from one of the most significant repricing events in commodity market history.